Hey there, welcome back to Accounting Stuff. I'm James, and today we're kicking off a new series covering financial ratios. These are the tools that help us analyze financial statements. First up, gross profit margin. What is gross profit margin? Gross profit margin is gross profit divided by revenue. It's a profitability ratio that measures a business's ability to generate gross profit from each unit of revenue earned. We often show it as a percentage, so if that's the case, then remember to multiply by 100. Gross profit is a business's revenue minus its direct cost of sales. So here's another way to write the same equation. And keep in mind, the cost of sales goes by a few different names. Cost of services if a business sells services, and cost of goods sold if it sells products. Anyway, let's break this down so we can get a full understanding of how gross profit margin works. We'll start with profit. You can find a business's profit on its income statement. An income statement is a financial report that summarizes revenue earned and expenses incurred over a period of time. Profit is the difference. It's the financial gain generated when revenues are bigger than expenses. Alright, so what about profit margin? Profit margin is the ratio between profit and revenue. It shows us how much profit a business generates for each dollar of revenue earned, or when we times it by 100, what percentage of revenue is able to convert into profit. For example, here's the income statement for a business called MAD. They're a tech company that makes processors and graphics cards out of California. Last year, MAD earned $1 billion in revenue, and they incurred $880 million in expenses. The difference of $120 million is their profit, which is the financial gain to their business. MAD's profit margin is $120 million divided by $1 billion. That's 12 cents of profit generated on every dollar earned. A 12% profit margin if we multiply by 100. Now, how does gross profit fit into all of this? Let's jump back to the income statement. This one's very compressed. In reality, businesses split out their expenses into a few different buckets. First, we take away the direct cost of sales. Then all the indirect operating costs like research and development, selling, general and administrative expenses, depreciation and amortization. And finally, we subtract interest and tax expenses. As you can see, the income statement shows three different types of profit. The big one at the top is called gross profit, the middle one is operating profit, and the smallest one at the bottom is net profit, the bottom line. So what is gross profit margin? At the start, we said the gross profit margin is a business's gross profit divided by its revenue. It measures how much big profit they're able to generate from each dollar of revenue they earn. Gross profit margin only factors in a business's direct cost of sales. It totally ignores all of the indirect operating expenses, interest, and tax that we can see further down the income statement. We use different ratios to measure those, which I'll explain in my next videos, so remember to click subscribe if you'd like to see them. I've also put together a new cheat sheet which shows all the different profitability ratios. If you'd like to support this channel, then you can buy it on my website. The link's in the description. Example time. What was MAD's gross profit last year? If we expand out their income statement, we can see that they earned revenue of $1 billion and they incurred $500 million in cost of goods sold. That left them with a gain in gross profit $500 million. So their gross profit margin is $500 million in gross profit divided by $1 billion in revenue. That's 50 cents of gross profit generated on each dollar earned, or 50% if we multiply by 100. But how should we interpret this? Is 50% good or bad? It's hard to say, so let's make some comparisons. First, what was the year-on-year movement in gross profit margin? Let's compare MAD's current and prior year income statements. we can see that they had a gross profit of $315 million in the previous year. When we divide that by their revenue of $700 million, that's a gross profit margin of 45%. So MAD managed to raise their gross profit margin by 5% year on year. That's good news because bigger is better. They managed to generate 5 extra cents of gross profit on each dollar they earned. They also managed to increase their revenue from $700 million to $1 billion. Things are looking promising. But how does their gross profit margin compare against their competitors? Here are the current year income statements for MAD and Inlet. Both of these businesses are in the same industry, so it's fair for us to compare their financial ratios. Inlet earned $7.8 billion in revenue, which is a lot more than MAD managed over the same period. They incurred $2.34 billion in cost of goods sold, leaving them with a gross profit of $5.46 billion. That's a gross profit margin of 70%, which is a lot higher than MAD's. It seems like Inlet is outperforming them. But let's make sure by checking out Inlet's year-on-year income statement. We can see that their gross profit margin actually decreased from 75% to 70%. Maybe things aren't as clear as they seemed. What could cause a decrease in gross profit margin? Gross profit margin is gross profit divided by revenue. And we know that gross profit is revenue minus cost of sales. So there are really only two ways that gross profit margin can go down. Either the sales prices are dropping, which could be down to discounting or a change in sales mix to lower margin products, or the cost of goods sold are going up. Maybe there's been some supply issues with materials or an unfavorable FX rate on foreign purchases. Perhaps direct labor costs have gone up. Who knows? On the flip side, an increase in gross profit margin could be caused by higher sales prices. There could be a larger demand for the products or services, or a change in the sales mix to higher margin products. Alternatively, cost of sales might have gone down. The business could have negotiated a discount with a supplier or switched to a cheaper one. They could have automated part of their production process, or maybe they're experiencing some economies of scale. With financial ratios, there's plenty to think about. Context is key. Thanks to all these legends for your support. If you'd like to become a channel member, then you can click on the join button below and let me know in the comments if you'd like to see any other financial ratios. Have a good one.